Hello, I'm Russ Mould, AJ Bell's Investment Director, and in this latest edition of our regular markets review, Breaking the Mould, I'm going to look at DIY, shopping and defence as the three issues which could well cause a real fuss in the week ahead. This is because on Tuesday the 24th of May we have the first quarter trading update from Kingfisher. On Wednesday the 25th, Marks & Spencer publishes full year results, and also on the 25th, Babcock releases its finals. So let's start with Kingfisher and its first quarter results on Tuesday the 24th, where boss Véronique Laurie will be looking to build on the share price momentum that's nicely developed since she unveiled a 5-year transformation plan for the owner of B&Q and Screwfix all the way back in January. Now, the market will be looking for an update on that 5-year plan, which includes work to simplify and harmonise product lines to help cut costs, a plan to expand the store footprint of Screwfix, and also to drive the digital platform forward. The idea is to generate an extra £500 million profit uplift over 5 years, albeit with the benefits back-end loaded as Kingfisher makes some chunky investments up front. Now, Kingfisher is also targeting an additional £600 million of capital returns to shareholders above and beyond its regular payments over the next 3 years. That's equivalent to around 26 pence a share, not to be sniffed at. Now, after a good run, the shares have begun to tread water a little bit, perhaps over fears the UK housing market may finally be cooling a touch as changes to the tax treatment for second homes and buy-to-let start to bite. Note that for the full year, analysts are expecting 4% growth in sales and earnings per share, so let's see how Q1 looks. Now on Wednesday the 25th then, let's get full year results from Marks & Spencer's, a high street bellwether if ever there was one. The stock's been a shocking performer over the last 12 months, so in some ways that makes new CEO Steve Rowe's job a little bit easier. Expectations are low and investors will be keen to listen to how he's going to try and reinvigorate the firm's growth profile. Rowe has already announced changes to the executive management team of the company, and he's made it clear alongside April's fourth quarter update that fixing the general merchandise or non-food side is his absolute priority. The fourth quarter at least offered some grounds for hope here, as sales fell but by less than expected. But there is still work to do, as this chart makes clear, not only on GM but also on the website, where 8% sales growth in Q4 was nothing flash, and M&S has really yet to get this right. For the full year, analysts are looking for pre-tax profits of around £671 million, a fraction up from last year's 661 on an adjusted basis. They're also looking for a 4% EPS growth and a small hike in the dividend to 19p. Now that doesn't sound too bad given the difficult high street environment, but this next chart shows the size of task that's facing Rowe. M&S is making less money now than it did a decade ago, which may explain why the shares have been such moribund performers. I'm not sure soon to retire CEO Peter Rogers will be too thrilled by this chart of Babcock shares over the past year either, but he does have a chance for a last hurrah before he steps down in August when he unveils the firm's full year figures, also on Wednesday the 25th. Babcock is a support services giant with Ministry of Defence, a huge customer. It runs naval bases, maintains equipment such as warships and nuclear submarines, and also trains staff for its customers. The UK Strategic Defence and Security Review, or SDSR, raised the UK spending budget to £178 billion over the 10 years from 2015. Babcock's already begun to win new business on the back of this, although it's not being complacent and is actively seeking to develop its non-defence arm. Services such as maintaining and decommissioning nuclear power plants now represent around 60% of sales against just 40% from defence. When looking at the figures, watch out for the order backlog, about £20 billion at the full year stage, and any comments on how the acquisition of Defence Support Group from the MOD is going. In terms of the other numbers, consensus is looking for pre-tax income of £456 million, up from £418 million a year ago on an adjusted basis, and a 9% hike in the divvy to around 25.8p. Now that's only enough for a 2.7% yield, below the level of the overall market, but note that earnings cover is comfy at nearly 3 times, and Babcock has increased the shareholder payout every year for the last decade, which is not a record to be sniffed at. Thank you for watching, and I look forward to seeing you next time.